Welcome to Breaking News to Trading Moves. Today we're focused on a pretty fast-moving situation at the top of the media world.
That's right. We're talking about the competing attempts to acquire Warner Bros. Discovery.
And this isn't just a theoretical corporate strategy session.
No, not at all. For you, the listener, the key is that this is a live bidding war. It's a direct competitive challenge that immediately got the market moving.
Right. So our goal here is to look at the proposals on the table for Warner Bros. Discovery, that's ticker WBBD.
And then we'll break down which companies got a lift from the news and which ones face some downward pressure when this new bid was announced.
Okay, so let's start with the core event. What exactly happened?
Paramount Skydance, the ticker is PSKY, made a hostile bid for Warner Bros. Discovery.
A hostile bid, and the number was what, over $100 billion?
Yeah, $108.4 billion. It's an offer of around $30 per share, and this is the important part, in cash.
In cash. And that's a direct challenge to the deal that was already in place, right?
Exactly. It stands in, well, stark contrast. Just a few days before, Netflix, ticker NFLX, had agreed to a deal for WBD's studios and assets.
But that was a different structure.
Completely different. That was a $72 billion deal, but it was an equity transaction.
Okay, so for anyone listening who doesn't live and breathe M&A, explain why that matters so much. Why does cash versus equity create all this immediate motion?
It all comes down to risk. In the equity deal, Netflix would have paid WBD shareholders with, new Netflix stock.
So you'd become a part owner of the new, bigger Netflix.
You would, but that means you're taking on future market risk, volatility, all of that. The cash bid from Skydance, though, that's immediate guaranteed value.
It's a sure thing.
It's a sure thing. And shareholders almost always prefer cash, especially at a premium. Skydance is going straight to them with a bigger, safer paycheck.
And what about the money behind this PSKY bid? It's not just the usual suspects.
No, the financing strategy is almost as much a part of the story. You have a mix that includes Jared Kushner's Affinity partners and also some Middle Eastern sovereign wealth funds.
So bringing in that kind of capital, does that signal they're willing to pay more than, say, a traditional Wall Street bank might advise?
It absolutely does.
Yeah.
And we have to talk about the backstopping power here. The Ellison family is personally backstopping over $40 billion of equity for the PSKY bid.
$40 billion.
$40 billion. That much private capital shows a deep conviction. They're telling the market they are prepared to fight for this, not just make an opening offer.
So you have the Netflix deal on one side, and now this really forceful PSKY offer on the other. What's the board at Warner Bros. Discovery saying?
Well, officially, the WBD board has acknowledged the PSKY approach and says it will review it. But, and this is the key for the market reaction, they also publicly stated they have not changed their support for the existing NFLX deal.
So they're keeping their options open?
They are. And that non-committal stance is what sets the stage for a long public bidding contest. That's what's fueling all the trading.
Okay, let's pivot to that. How did the market actually process this news? Let's start with the winners on the day of the announcement.
The first and most obvious category is what we call the deal stocks.
The companies directly involved.
Right. Paramount Skydance, PSKY, and of course Warner Bros. Discovery, WBD.
So why did the street reward WBD? You'd think a new hostile bid introduces uncertainty, not a reason to buy.
You might think so, but WDD is now in a fantastic position. They are being actively pursued by two separate, well-financed bidders.
Which means the final price is probably going to be higher.
Exactly. It creates a higher implied floor price. The trading volume shot up because everyone knows the bidding isn't over yet. The price will likely go above that initial $30 offer.
And what about PSKY, the bidder? I mean, aren't they taking on immense risk with a $100 billion cash offer? Shouldn't the market punish that?
It's a classic situation with hostile bids. The market immediately starts viewing PSKY as an event-driven stock.
Meaning traders are betting on the outcome.
Yes. They're playing the odds. Will the deal succeed? Will they have to sweeten the terms? Will another rival bidder appear? All of that keeps volatility high, and the stock gets a boost for being the main character in this drama.
Okay, let's move to the second group of winners. These are the big legacy media companies with real scale. We're talking about Disney, ticker DIS, and Comcast, CMCSA.
Right, and they're benefiting because this whole situation validates the narrative that's been driving the sector.
The idea that you have to be huge to survive.
That's it. If regulators allow either a Netflix Warner or a Paramount Warner combination, it just confirms that only massive, diversified media groups will be left standing to dominate premium content.
And so Disney and Comcast look safer by comparison.
They look much safer. They already have the global brands, the sports rights, the multiple distribution channels. They're seen as the established survivors who don't have to pay a massive premium to get the size they need.
Now, the third category of winners is the cinema chains. Specifically, AMC Entertainment, AMC, and Cinemark Holdings, CNK.
The connection here is all about the supply chain. It's about content.
A bigger, more powerful studio means more big movies.
A combined, fortified studio with deep franchises, which WBD certainly has a clear incentive to keep pushing big tentpole films through theaters to maximize their return.
So a stronger owner for Warner's film library suggests a fuller schedule of blockbusters.
Yes, and that's good for anyone who relies on the box office, so names like AMC and CNK get a lift. A more reliable supply of big movies helps stabilize their future earnings projections.
All right, we've covered the beneficiaries. Let's look at the other side of the coin, the companies that faced downward pressure on this news.
The most obvious one is the first category, the current rival bidder.
Which is Netflix.
Netflix, NFLX, and also platform names like Roku, ticker ROKU.
So with Netflix, was the market punishing them for their initial bid being too low, or just for the new uncertainty?
It's a bit of both. NFLX suddenly has a live, cash-rich competitor for the exact same asset. That creates a lot of uncertainty about the timing of their own deal.
And it probably means they'll have to pay more.
Almost certainly. Investors are now pricing in the high probability that Netflix will have to sweeten its offer, which could mean taking on more debt or diluting their stock more than they originally planned.
Okay, let's talk about Roku, ROKU. They aren't a studio. Why are they feeling pressure just because two content companies are fighting?
Yeah, the rationale for ROKU is a bit deeper. Their business model relies on ad revenue from their operating system.
And their ability to negotiate with streaming services.
Correct. So if a mega studio plus streamer is formed, like a combined WBD and Netflix, they might decide to keep more of their content inside their own ecosystem.
A walled garden.
A walled garden.
Yeah.
And they want to control all the data and advertising that comes with it. That means they could start negotiating much tougher distribution terms with platforms like Roku, which threatens Roku's growth.
Moving on. The second category on the downside. Smaller and mid-tier TV and cable players. We saw sell-offs in stocks like Fox Corp, FOX, and Tegna, TGNA.
This is all about structural pressure in the ad and distribution markets.
How so?
If another huge content bundle is created, advertisers and distributors, well, they prefer to deal with few large integrated players. It's just simpler.
And that squeezes out the smaller guys.
It does. It puts pressure on smaller broadcasters like Fox and local station owners like Tegna. They rely on things like carriage fees and having access to strong programming. As consolidation drives up content costs, their profit margins look a lot tighter to investors.
And the final group that felt the pressure, independent content producers without scale. Names like Paramount Global, PRA, and AMC Networks, AMCX.
The issue here is a loss of bargaining power. And we should clarify, PRA is Paramount Global, the standalone company, not Paramount Skydance, the bidder.
So why does being subscale matter so much now?
Because as more and more premium content libraries get locked up by a handful of giant companies, the smaller studios and networks just lose leverage.
Their ability to negotiate is weakened.
Right. Their own valuable content libraries become assets where the price is dictated by just a few powerful buyers. So names like PRA and AMCX, they just aren't at the size of the mega bidders, and investors worry they'll get squeezed in rights negotiations and in the fight for advertising dollars.
So what we're really seeing is this accelerating contest for premium content assets. It confirms that drive towards consolidation across the entire media sector.
It does. The market has basically instantly repriced almost every media player based on whether they're likely to acquire, be acquired, or just get pushed to the side by these new giants.
And what's a final thought for our listeners to consider?
I would say consider the strategic value of that $40 billion being backstopped by the Ellison family in the PSKY bid.
The sheer firepower.
The firepower. That level of committed capital signals an expectation that the future of content will be decided by those who can spend without restraint. Regardless of which merger wins, that sets a new bar for what it costs to compete.
It is crucial to remember that this discussion is based purely on the information available on the day of the announcement. This is not financial advice, nor is it a recommendation to buy or sell any security. These are purely the opinions of the author of the material we reviewed.